Alrighty, good morning. My name is Nat Kellogg. I'm the Director of Manager Search here at Marquette, and I'm going to be kicking off the Marquette research portion of this morning's symposium with the first of our 6 flash talks. Now, for those of you who have been here in the past, we're going to follow a similar format that we've used in prior years. We're going to do a series of 6 flash talks. Each flash talk will be about 15 minutes in length. We'll split these up into 2 sessions to give you guys an opportunity with a short break in between to stretch your legs, check your email, refresh your coffee. We are not going to be doing a formal Q&A session with any of the flash talks, but all of the speakers you hear this morning will be up here around the stage, both during the break as well as at the end of the symposium. So if you have any questions, please feel free to come find us. We'd be happy to chat about anything we've discussed here this morning in greater length. So with those logistics out of the way, let's jump right in. This morning, I'm going to be talking about the case behind ESG investing and how we're increasingly seeing investment managers implement this in practice within client portfolios. A quick agenda for this talk, briefly explaining what is ESG investing, talk about how we're seeing investment managers use this in client portfolios, thinking about environmental, social, and governance factors, talk a little bit about the trends we've been seeing in the marketplace, and then last but not least, we would be remiss if we did not give you our 2 cents on our approach to ESG investing and where we see this going in the future. So what is ESG investing? ESG investing is the incorporation of environmental, social, and governance factors into the fundamental investment process. Now, attitudes towards ESG has certainly evolved a lot over the years. So this cartoon comes from Pension and Investment magazines back in January of 2013. And I think encapsulates a lot of the concerns around ESG. The idea that there was this trade-off. You could either do well with your investments or you could do good with your investments, but you couldn't do both at the same time. Things have changed a lot over the years. This cartoon comes from the same magazine, Pensions and Investments, about 5 years later. And I think this much better encapsulates where the attitudes are towards ESG investing today. Increasingly, we see investment managers using ESG factors in their security selection process to drive alpha in client portfolios. So what I'm going to do this morning is sort of talk about a couple of different case studies within E, S, and G and how we're seeing investment managers implement that. So from an environmental perspective, increasingly you're seeing people use ESG or environmental factors to help better identify and manage risk in portfolios. So a good example of that is thinking about environmental disasters and the associated liabilities that come with those disasters. So on the left-hand side, what we show you is the Exxon Valdez. You guys are all probably very familiar with this. Back in 1989, at the time, it was the largest oil spill in history when the Exxon Valdez oil tanker ran aground. This was a PR disaster for ExxonMobil and caused significant environmental damage, but somewhat surprisingly, only generated about $7 billion in liabilities for ExxonMobil. Now, things have certainly changed over the years. This middle picture we show you is from the San Marco Dam collapse back in 2015. San Marco is an iron ore mining company. It's a joint venture between Vale and BHP. It had a dam collapse and wiping out a number of towns in Brazil that sat below the dam. This generated over $50 billion in total liabilities. And then last but not least, the largest one of them all, the Deepwater Horizon oil spill. The Deepwater Horizon oil well was owned by British Petroleum. This occurred back in 2010 in the Gulf of Mexico. And to date, BP has paid out over $60 billion in total liabilities associated with this disaster. So what's the market reaction been? What we're showing you in this chart is the performance for each one of these companies in the 100 days immediately after the disaster. And what's interesting, look at the blue line there, that's ExxonMobil back in 1989, and you can see the market reaction was relatively muted, sort of consistent with the overall scale of the liabilities that they had to pay. Compare that to Vale and BP, whose stock prices declined somewhere between 40 and 60% in the 100 days after the natural disasters they were involved with. Kind of an interesting aside on BP. So BP stock was trading at about $60 a share for the month leading up to the 2010 Deepwater Horizon incident. Today, it's at just $35 a share, and at no point in the prior decade has it ever reached that $60 a share level again. So you can see some of these have some pretty long-lasting consequences. Now, one of the other things people talk a lot about from an environmental perspective is stranded assets. So if you think about the value of resource companies today, right, energy companies, mineral and mining companies, a lot of that value is tied to assets that remain in the ground, with the view that oil will eventually be pumped, gold will eventually be mined. But what if those assets are never extracted? What effect does that have on the market? Well, I think the coal industry is a good microcosm or a good example of that. So the left-hand chart, what we're showing you is coal production and consumption in the United States going back to 1950. And you'll see that peaked back in 2005. So in 2005, coal-fired power plants accounted for about half of all electricity generation in the United States. Fast forward to today, just 15 years later, and that sits at about 27% of overall production. The effect on the coal industry, as you can see on the right-hand chart, has been pretty devastating. So this is the Dow Jones US Coal Index. It's an index of all the publicly traded coal companies in the United States. And the performance over the last decade has been nothing short of abysmal. If you go to the very lowest trough there back in 2015 and 16, essentially every coal company in the United States went either through bankruptcy or some sort of major restructuring. So if environmental factors are about identifying risk, social factors are increasingly being used to identify companies that can outperform. I think a good example of this came from a Credit Suisse study done back in 2016 that showed that companies with a higher level of women in senior management consistently outperformed their peers from a return on equity basis. And interestingly, these same companies were able to do this not just through financial engineering, but actually through fundamental outperformance. So if you looked at those same companies, they actually had a lower net debt to equity ratio and higher return on equity. One of the other social factors that's very important to folks is thinking about fair labor practices and employee satisfaction. And an interesting study related to this came out earlier this year by a group called Glassdoor. So Glassdoor is a website that lets employees anonymously rate their employer. They can post salary information, they can describe what the interview process is like, give scores on whether they like working there or not. They even actually can rate the CEO. You can go online and see what people think about Marquette, both current and former employers. And Glassdoor uses this information to sort of drive insights into the marketplace. And so one of the things they came out with from a study this year is showing a strong correlation between a company's Glassdoor rating, i.e. how happy employees were, and a correlation between the American Customer Satisfaction Index, or customer satisfaction. This is something that certainly resonated with me, as I am an avid Southwest flyer. I have an iPhone in my back pocket, and I shop at Costco almost every weekend with my kids. Now, it's important not to confuse correlation with causation. What we're not saying is that just focusing on these social factors alone will immediately improve a company's operating performance. What we are saying is that these social factors, companies that score well on these social factors, are often indicative of firms with very strong cultures. I think Professor James Haskett said it best when he said an organization's culture can be its best competitive weapon. And how often have you heard a CEO said, our people are our most important asset? I think Brian said that just this morning. Marquette is a great place to work. Now, I can vouch for that. That is 100% true. But put yourself in the shoes of a financial analyst looking at a company. If every CEO says we have a great culture and our employees are super important, how do you tell from the outside looking in? Increasingly, what we're finding is that social factors are a great way to identify companies with strong cultures that can competitively outperform their peers. Now let's talk about governance. Now, governance is something that's probably been key to most fundamental investment analysis process for the longest. Thinking about capital allocation and CEO compensation has always been important from a financial analyst perspective. But things are changing a bit. One of the things that is changing is how we think about active management. So historically, when we've all talked about active management, what we're talking about is actively buying and selling shares, right? It's the idea of taking active bets relative to the index, trying to outperform. But increasingly, when we're talking about governance perspective, active management is being an actively engaged shareholder. It's being actively involved in the company, in the portfolio. So what we're showing you here is the number of activist campaigns launched in the United States over the last decade. I think one of the other interesting things going on a little bit below the surface here is if you go back to 2010 and 11, this was strictly the purview of the hedge fund community. Fast forward to today, and many more long-only managers are involved in the activist process. So what are they typically fighting for? This looks at the proxy campaigns that have been launched in the S&P 500 in the last 2 years. And you can see these are focused on things that are tightly tied to governance. So reducing conflicts of interest, things like political contributions and limiting lobbying. And then overall better governance. So thinking about having an independent board chair, declassifying the board. All things that lead to better governance in corporate America. The other thing that's incredibly important is CEO compensation. And I think this is kind of an interesting case study here. So all of this data comes from Bloomberg. Bloomberg actually now has a dedicated ESG module. So you can pull up any company in Bloomberg, type in ESG, and you can see how that company scores relative to their peers on a lot of different ESG factors. This is one example from the auto industry where we have GM, Ford, and Tesla. Now, if you look at their governance structure from a board perspective, it's all relatively similar. But what's somewhat surprising is Tesla's ESG scores are not great. Given the fact that they have sort of zero-emission vehicles, that might come as a little bit of a surprise to you. But one area that Tesla really falls short is around CEO compensation. Now, it's not that the CEO of GM and Ford don't make money. You don't have to feel bad for them. They're very well paid. But Elon Musk's compensation is clearly off the charts relative to his peers. So let's talk a little bit about what we're seeing in the industry today. First and foremost, interest, I think, has never been higher. What we're showing you here is a Google Trends analysis of the search term ESG investing. And as you can see, performance today is at an all-time high. I think that's really important for us to remember as investment committee members, plan sponsors, and advisors. Our participants are increasingly interested and increasingly asking about this. Not too surprisingly, you have seen institutional investors react. This shows you the amount of ESG assets in the United States. Today, almost 1 in 4 institutional assets is managed with some level of ESG criteria. So this is clearly something that's gaining traction in the marketplace. Not only is this happening amongst asset owners and asset managers, but it is actually happening at the underlying portfolio company level as well. So if you go back to 2011, just 20% of the companies in the S&P 500 produced an annual corporate sustainability report. If you look back to last year in 2018, 86% of the companies in the S&P 500 were now producing annual sustainability reports. I think the culmination of this was an announcement earlier this year by the Business Roundtable. Now, the Business Roundtable is a nonprofit organization made up of C-level executives from Fortune 1000 companies. And the Business Roundtable came out earlier this year redefining the fundamental purpose of a corporation. So no longer is the only goal of a corporation to drive value for shareholders, but focusing on a commitment to all stakeholders: customers, employers, employees, communities, and shareholders. This was something that was signed by the chairman or CEO of 185 public and private Fortune 1000 firms. And actually, if you print out the actual document, and you'll see the very first signatory on this list, it's A.O. Smith, a water heater company based up in Wisconsin and a longtime Marquette client. Now, increasingly, it's become important to have a common language when we're talking about ESG goals, and these have increasingly become the Sustainable Development Goals, or SDGs as they're often called. These were laid out by the UN back in 2015 as part of the 2030 Agenda for Sustainable Development, and I think you will increasingly hear these are kind of a lot of the factors that investment managers are focusing on when they're thinking about ESG factors within your portfolios. Now, a good question to ask is all this focus on ESG having an impact? This is only one example, but I think the early returns would say yes, absolutely. So what we're showing you here is the percentage of women in corporate boards for MSCI ACWI companies, so around the world, and we break it down by industry. And while there is clearly still a lot of work still to do, you can see that there's been some market improvement over the last decade, and the trend is obviously headed in the right direction. So our take on this. We have spent a lot of time over the last few years looking at investment managers, seeing how they incorporate ESG, looking at ESG dedicated strategies. And here's our view on some of the best practices, some of the things you should look for if you're considering a manager with ESG criteria. First and foremost is having dedicated ESG resources. So individuals at a firm who are focused on looking and analyzing companies from an ESG perspective. Having a consistent system for systematically scoring companies on multiple ESG factors and allowing them to be able to compare companies across industries and across sectors. And then incorporating that data into the fundamental security selection process. Now, the other thing I think is really important is ESG is not just about screening. So it's not only about not owning companies that are doing things you don't like, but it's also engaging the companies that are in the portfolio. So having internal resources that are proactively engaging portfolio companies is incredibly important, whether that's how they vote proxies, launching proxy campaigns, or interacting with company management. And then last but not least, for those of us as fiduciaries, having clear and measurable reporting. So how do we know that things are improving? How do we measure what kind of changes are going on at the underlying portfolio level? The reporting piece is an important part of the overall pie. Last but not least, looking into our crystal ball, where do we see this all going? So first and foremost, I think this is going to be increasingly become just sort of standard operating procedure. Just like we ask managers today about their trading or their back office and technology, I think everybody will be including some level of ESG factors, analysis, and criteria in the investment process. As I've shown, it helps returns, and I think more and more you will see investment managers incorporating this into their process. I think this is true at all levels. So this will be true at the company level, thinking about corporate sustainability and responsibility. At the asset manager level, incorporating ESG criteria in the security selection process. And at the asset owner level, thinking about ESG considerations within the investment policy statement. And then last but not least, I think this is really a new and exciting frontier for both asset managers and asset owners. So from an asset manager perspective, kind of redefining what we think about active management and some of the tools and value add that active managers bring to their clients. And for us as asset owners, thinking about not only doing well with our assets, but also doing good. With that, I want to thank you all very much for your time this morning, and I'm going to call up my colleague Jeremy Zarian to talk a little bit about opportunities in non-core real estate.